Hello, hello, everyone. The markets are officially closed. I didn't realize we were starting this right as market closed, but I just got the Blossom notification, then the market's closed. So perfect timing here.
Good.
And I already seeing a great comment here from Bradley. Time to learn why Nvidia is undervalued, which we'll see. We'll get into that. Maybe not. But thank you everyone for tuning in today here on a Tuesday afternoon. Thank you everyone who's going to be watching this after the live session. Really excited to be moderating today's panel. Braden and I were talking about whether I should moderate or whether he should moderate, and I basically begged him to let me moderate this one because I'm very deeply interested in this topic. As many of you guys know, in the Weekly Buzz, like over the last year, so many of the articles have been about AI, about the earnings, about looking, on this question, are we in a bubble or are we, where are we in the cycle? Are we just at the start of the boom? And really excited about the two, awesome panelists we have today who aren't not just incredible commentators in their own right, but are also founders, like myself, who have actively been using AI to make, life easier for investors, like me and you. To introduce myself quickly, for those who don't know, my name is Max. I'm the CEO and founder of Blossom, the social app for investors. Probably many of you are coming from the Blossom community, so I'm assuming, and I see some familiar faces, and Jacob, Andres, great to see you guys tuning in. But without further ado, let me introduce our awesome panelists. So first up, Braden Dennis. Braden is the host of the Canadian Investor Podcast, which many of you likely know. It's the #1 investing podcast in Canada. Over 1 million downloads. I think well over 1 million downloads, Braden, right? Like I just sort of
I think we're over 5 now.
Over 5.
I'd have to look. Okay. You just use the same bio in like 10 years. Like he's got over 1 million downloads.
Yeah, exactly. Well, it is over 1 million. But I actually, it's funny, when I was getting introduced in the Money Show, they had an old bio where it was like Blossom has like 30,000 users, and so it's always great to be like, actually, we're at 5 million now. But some of you may also know Braden as the founder and CEO of FinChat, which is an awesome tool for investors, one of the most prominent startups and tools for AI investment research. Sort of like chat. I'll let you chat more about that, Braden, but sort of like ChatGPT, but for investing. Next up, Daniel Pronk. Daniel's one of Canada's largest investing YouTubers, over 240,000 subscribers, author of an Amazon bestseller, The Fundamentals of Investing. He's also the founder and COO of Stock Unlock, which is an awesome platform, financial education platform built for fundamental research, inspired by investors like Buffett and Lynch. So I wrote in my notes a big round of applause for our two panelists, but I realized we won't be able to hear the applause. So virtual applause for the two of you here. But to break the ice, and so I'm not doing all the talking here, how about we start each with a fun fact and then share a little bit about FinChat and Stock Unlock so people have the context as we get into the discussion. And how about we start with Daniel?
Yeah, thank you for having me on, Max. It's always great to hang out with you guys and talk and whatnot. So yeah, as Max said, I'm Daniel Pronk. Interesting fact about me, I guess, is that I actually started my YouTube career, I think back in like 2010. I was making Modern Warfare 2 montages. I was trying to become a gaming YouTuber. So that's where my journey on YouTube started. And more about Stock Unlock. Yeah, it's a fundamental and portfolio tracking platform to help people make better investment decisions, kind of speed up the research for people. And it's more focused towards the individual investor to try and get individual investors and put professional tooling in their hands at a very affordable price. So that's kind of our mission over at Stock Unlock.
That's awesome. Great fun fact too.
Thank you.
Braden, you go ahead.
Hey everyone, thanks for coming on the webinar today, and shout out to the Blossom team for setting this up. My name is Braden Dennis, co-founder and CEO of FinChat. FinChat is building the future of investment research, whether that's the front end of how you interact with data and do research, but also in how the data is aggregated using machine learning. Fun fact about FinChat is my co-founding team, other than my CTO, who we've known for a long time, I recruited almost entirely from Twitter, from anonymous people. One of my co-founders, Adrian, I thought that he was going to be somewhere far in the world because he was aggregating all this awesome data for software companies and Lululemon and these kinds of things. I DM'd him, and it turned out he lived, I kid you not, 5 minutes from my house. And so that was, one of those things where things just work out.
It was crazy.
He could have been anywhere. He was an anonymous Twitter account.
Yeah. Daniel, you also met your co-founder like through the internet, right?
Yeah, he was a viewer of my YouTube channel, and then he spammed my inbox for about 2 months before I finally replied to him.
That's awesome. And now that was a great match made in heaven.
Yeah.
I'll share a fun fact just to complete the circle here. My first business was actually cake decorating. So I sold like cakes and cupcakes in my like small town in rural BC. And that's sort of what got me into business. So I was selling like little cupcakes at the farmer's market. So yeah, that's my origin story, which some people may or may not know. But let's kick things off for the panel with sort of the classic Blossom question. And I think this will probably touch on a bit of the AI pieces here. But what is your biggest holding right now and why?
I can kick this off. The listeners of the podcast will know that I've been banging the drum on Constellation Software for the better part of a decade now. So since I've never sold a single share and don't have much intention to, that and the spinoffs is around 60% of my portfolio, which is hard to stomach for some folks, but I think it matches. I try to match my conviction with my portfolio weighting, and I feel just fine at night with that size.
What, maybe we'll get into it later, but what is it about, or even maybe what is Constellation Software and why are you so bullish? I'm not even really familiar with the company, to be honest.
Constellation Software is one of the largest companies on the Toronto Stock Exchange. It is a global, headquartered out of Toronto, but global acquirer of niche vertical market software companies. So they own a collection of around 1,000 vertical market software companies. So think of a private equity vehicle, but publicly traded. It's headed up by Mark Leonard, who's probably the least known, least documented billionaires on the planet.
Very interesting. I did see that in your Blossom profile, and I was like, "There's no way he owns this much," but it's true. So, what about you, Daniel?
First, fun fact about Constellation Software. So in my book, I have a chapter dedicated to the best business I've ever seen in the stock market. It's a full chapter on Constellation Software. It is truly an incredible business.
Yeah, it's like a 200 bagger on the TSX now.
Yeah, and it's never had a drawdown of over like 25%. It's just insane. Yeah, fantastic business. My largest position is Brookfield Corporation, BN, on the TSX.
And I know you've made lots of videos on that one too, Daniel. Yeah, one recently, right? About
yeah, I mean, the reason I like Brookfield so much, well, it's got an incredible management team, long track record of growth, hitting expectations, exceeding expectations, and they're kind of just in everything. Like everything that I am bullish on, nuclear energy, AI, data centers, infrastructure, they're just always in it. So it's just, for me personally, it's just like the perfect investment. So that's why it's the largest position.
Very cool. Very cool. We'll have to rename the session to like Constellation X Brookfield. Why to buy? No, I'm just kidding. I don't hold either of those, but I'll definitely add them to my watch list after here. And Daniel, I've seen a bunch of those videos that you've made. But onto the topic of the evening, AI bubble or boom. Very excited for this topic, and I know Daniel, you made an awesome video about 3 weeks ago with the title "Bubble Alert," and I'm not sure if that was just to get more clicks to the video, but you presented a lot of very interesting charts and data throughout that video. Two that I want to touch on as we get into the question is number one, S&P trading at a forward price to earnings well above its historical average. I think is around 21.5x when average is like 16, 17. And for those who are maybe more beginners, price earnings is essentially a measure of like how expensive stocks are. in the market. And the other chart here that I thought was very interesting was the weightage of the top 10 stocks in the S&P being at their highest concentration in 30 years at around 36%. And so maybe to use these two charts as a jumping off point to the question, how do you think about the current valuations? Do you think they're justified? Do you think we're in a bubble? And Daniel, we'll start with you, but Braden, feel free to chime in. We'll keep this very conversational.
Yeah, this is a tough question. So in general, I do believe that the S&P is quite expensive right now. I don't necessarily think that we're in bubble territory. I mean, in the screenshot that we have up here, back in the tech bubble, the forward price to earnings ratio of the market was 25.2 at the same time as the 10-year treasury was yielding 6.2%. Today, the forward price to earnings ratio is lower and interest rates are quite lower. And when interest rates are lower, valuations of everything kind of just go up. So I don't think that we're necessarily in a bubble. I just think that things are quite expensive. And that's kind of my opinion. I think that there's definitely some areas of the market that do seem bubbly though, but there's also areas in the market where I think there's tremendous value. So when I say the market, it's pretty much the S&P 500, but I do always believe that there is value out there somewhere.
Braden, what are your thoughts or anything to add on that?
I did a podcast segment that comes out on Monday on this exact topic. So I got to reuse some data on the ready here. What is the S&P 500? What is the NASDAQ 100? What is the TSX 60? They are a basket of stocks that are tracked under one kind of easy to understand index. And the top 20 companies in the S&P 500 20 years ago, in 2005, were of the following: ExxonMobil, General Electric, Microsoft, Citigroup, Walmart, Johnson & Johnson, Pfizer, Bank of America, IBM, and Intel round out the top 10. Okay, so in the top 20, it's a mix of banks, natural resources, commodities, telcos. So these were at the time the businesses that ruled America. Okay. The top 20 today are Apple, Nvidia, Microsoft, Google, Amazon in the top 5. Meta, Berkshire, Saudi Aramco, Taiwan Semiconductor, Tesla, Visa. These are the businesses that rule the world. And that's a really significant difference. The businesses 20 years ago that were about half the S&P ruled America. The businesses today that rule the S&P rule the world. And so that's a very significant difference. If you were to take the top 20 companies on the S&P 500, equal weight them and put them into one business. You can do this on a FinChat dashboard. You make the companies, equal weight them, and see what the company would look like, what that portfolio would look like. Operating margins above 30%. Expected to grow profits over 20% per year over the next 2 years. 25% net margins, and has grown revenue on the last 5 years on a compound annual growth rate of nearly 17%. That's a pretty amazing business, like a fantastic business, really. And so is the market expensive? Yes. It's closer to screamingly expensive than screamingly cheap. But I think if you look back out the data and you say, okay, it's trading at elevated multiples over the last 40 years, yes, because those indices used to be run by the companies that ran America. Now these indices are ran by the companies that rule the world. They touch billions of customers. Cloud computing was invented in 2006. That's when AWS came online. It was invented earlier, but that's when it was actually commercialized by Amazon Web Services. Mark Zuckerberg started using Harvard data in 2004 to eventually build Facebook in 2005. These are businesses that touch billions of people. And so is the market cheap? No. But are the businesses fundamentally different in the top of these indexes today? Yes.
That's a very interesting point, Braden. I remember chatting with someone too around S&P's country exposure, right? And or geographic exposure, obviously being all US companies. But then to your point, it's actually the revenue mix, right? A lot of their revenue comes from international markets, and how that's changed a lot over the over the last years. Daniel, anything to add or respond to Braden's points there?
No, that's just a really good point. And I think to elaborate on that point more, I think what Braden is saying here is, since the quality of the top businesses in the S&P 500 is so much better than it was historically, the argument is that that should command a higher premium than how the S&P has traded historically. So therefore, the expensive price today may actually make sense and be justified.
Yeah, capital is gonna flow where it's best served. I mean, you can think of capital flowing like a pipe, right? If there's less pressure on this side of, like a wider diameter on this side of the pipe, the water's going to flow there naturally. It's going to flow where it's best served. Capital always will. And these companies are fantastic. Do they come without any risk? No. This is the beautiful thing about our world, right? Is capitalism exists so that there's competition. There's companies like FinChat and Stock Unlock that can exist and challenge the status quo. That's the benefit of capitalism. So are they a slam dunk? You're gonna be able to own them for 100 years and they're just gonna prosper forever? No. But on average, the quality of the companies that I mentioned are just fantastic. Like operating margins and like EBITDA margins and growth rates above 50%. There's the rule of 40, which is known as like amazing in software. These companies that are worth trillions of dollars are like rule of 50. And I mean, that's pretty impressive. It really is.
Yeah. One question I have on that, because as of course, if we look at the earnings of Mag 7 or big tech, right? We see so much growth in the cloud services business, whether that's AWS, Google Cloud, Azure, right? And that's like a huge part that people are like pointing to. Someone had a question. I'm going to jump to whose question is it here? Like Labib from Blossom commented on one of my posts around, obviously there's so much capex going into AI. Some of the returns here are like those the web services, but ultimately like Nvidia is sort of selling the shovels to the Mag 7, right? Because they're buying the GPUs to power the web services business, and then even the web services business are sort of selling the shovels too, in a way where it's startups or other large companies that are using the web services to power their AI, but I think the thing that matters at the end of the day is like the downstream, like is the AI actually providing an ROI that justifies those investments? And Labib asked something around, understand the usefulness of AI internally, but is it going to make Procter & Gamble spend more ad money on toilet paper, right? For if we think of Google and Meta. Do you guys think that based on the numbers you're seeing, like that the capex is paying off? Or do you think that they're still sort of overspending and that maybe provides some risk?
Dan, you want to go? I can take it after.
Yeah, sure. Yeah, I think for me, it's hard to know if all of the capex is making sense right now. It kind of seems like these companies are spending as much as they possibly can. And really, as the investor, you kind of just have to trust the management at this point. I believe Andrew Jassy over at Amazon was saying this is one of the best investment opportunities he's ever seen in his lifetime. And that's why they're throwing hundreds of billions of dollars at capex. And yeah, I'm not sure when the ROI is going to be there. It seems like AWS is still growing. That business is still scaling quite well. But yeah, at the end of the day, you just kind of have to have faith in the management at this point.
So here's the lay of the land in the tech value stack for AI. Shout out Michael Parek on his Substack who made this graphic. I think it's fantastic. And even if I can share my screen, I'm happy to do so. But it's really simple. So at the bottom you have energy and power. So I'm going to go up the stack in the value stack of how things are created when we're talking about AI. So first you have energy and power, and then you have the chips and all the design and lithography and fabrication of chips. That includes the designers like AMD, Nvidia, whoever else. Then you have the cloud compute services, so AWS, Azure, Google Cloud, and others. And then you have the data layer. And then on top of that is all the software that everyone's and there's a lot of investment happening in software, a lot happening in the bottom of the stack. But most of the value is accruing right now lower in the stack. And the jury is still out that every single company needs to have AI front to back on it. The jury's still out on that, and whether it will make Procter and Gamble make more toilet paper, no, not necessarily. But the compute required for more complex workloads, it makes so much sense for these big cloud providers to have the most advanced GPU clusters. And that's why Nvidia is accruing so much cash from this, right? Each one is cost tens of thousands of dollars. They're in a race against each other to buy as many as they can. And certain workloads that you might want to do with NVIDIA GPUs in an AWS data center, for instance, engineering simulations, computational finance, building genomic models for solving very complex molecular biology. I'll give you another example that hits close to home. So FinChat is a data company at its core, and we're aggregating a ton of data from public sources. And we use a lot of AI for it and a lot of traditional techniques as well. We use a lot of compute, like we are a very healthy big cloud provider customer. And whoever will give us more credits is basically who we'll give our money to right now. And so if you want to throw that chart on there, Max or Brandon, this is the quarterly revenue for Amazon's cloud, Google Cloud, and Microsoft's cloud. And they're not all apples to apples because Microsoft bundles in a lot more stuff. Amazon AWS is still the king. Even though it's the blue line and the smallest one, or the smaller one, middle one, Microsoft bundles a lot of other stuff in there. And look, this is per quarter. So we're talking about over 100 billion run rate for AWS, 150 plus billion run rate for these other companies. It is significant, and I'll leave with Gavin Baker from Atreides Capital Management. He was talking a lot about this of like, is there going to be positive ROIC for this investment? And he left with, these companies are trying to build a digital god, so none of it matters. The math doesn't matter because if you can build digital god, what was the correct price to pay? And I think that's the sentiment from these capital allocators right now. Whether it's right or wrong, I don't know. But what's the right price to pay for digital god?
I mean, that definitely reflects, I think, like comments we've seen with like Mark Zuckerberg, for instance. And I find those very interesting, where Zuckerberg basically said, like, yeah, companies are overspending, but the downside risk of being left behind is more than the risk of overspending. I'm not sure, like, that makes sense, right? Like if you think about even just the Cold War in history, the same with like Russia versus US, like and basically an arms race, right? Where they're spending on all of these different technologies and especially weapons, because they don't want to be, left behind, and the risk of being left behind is worse than the risk of overspending. Does that sort of sentiment like concern you guys at all, in that like that seems to me like the exact sentiment that would like drive a bubble, where it's like no amount of spending is like too much, like the ROI is like potentially infinite. Any thoughts on that?
Yeah, so I've been reading through Berkshire Hathaway's or Warren Buffett's letter to shareholders. I just finished reading through all of them. And there was some quotes in his letters where he was saying there's certain businesses where they have to sprint just to stand still. And I kind of feel like that might be happening in the AI space, as you just described. Like these companies are at a point where they have to spend as much money as they possibly can just to not lose. And then it's also like not everyone can win. So some of these businesses, in my opinion, that are spending these tens of billions of dollars, if they don't win, then the ROIC on that investment could be quite low. So yeah, to me, it's uncharted territory. I think there's probably space for a lot of these companies to win at the same time, and they obviously are right now. But yeah, like some of the smaller companies that you hear about where they say, oh, we're investing in AI, and it's like, what does that actually mean? And then they're spending all this money. That's kind of the stuff I worry more about.
And maybe let's talk about that, right? Like we were talking about this a little bit before we went live around Braden. I think you said like there's always junk, no matter where you look in the markets or what time you are in the markets, there's always going to be junk. Can you elaborate on that a little bit and like I guess some of the junk that you're seeing in AI? And you don't have to talk about specific companies, but maybe like signs to look out for of like whether a company is like junk.
Yeah, I think if we look back at historical times where there was a lot of hot air in the market, a lot of people will think now kind of rhymes like that, 1999 for sure. And there were businesses trading at billions of dollars in valuation on slide decks in 2021. This happened in 1999, of course, with the tech bubble, and then that didn't work out particularly well. But during that time, there were still businesses that were executing and had real fundamentals, real customers, real product market fit that was happening, while a bunch of junk got bid up very high. I mean, Dogecoin is a 53 billion market cap asset today as of recording. Might be more. I looked 4 hours ago. It's probably more. You don't have to be a financial forensic expert to know that that's full of hot air, right? So there's a lot of stuff that tempts investors in bull markets. You just got to really focus on the fundamentals. And that's why we at FinChat, we try to build a data set where you can look at the actual KPIs of the business, like the actual fundamentals, right? Is like, okay, Netflix only moves on subscriber counts. So that's the only number I'm going to focus on. It doesn't move on earnings per share. It doesn't move on revenue growth. It moves on subscriber ads and average revenue per user in each region. And estimates around that number. Everything else is mostly noise, right? And so if you know that and you reverse engineer that, it makes your life a lot easier.
Yeah. And to build on, or actually, Daniel, anything to add on that before I jump to sort of build on it?
No, I think that was a good point. Just to, I guess, build on that a little bit. What was interesting in 2021, as Braden said, was, we had SPACs coming in and they would hit the market with a slide deck and get a $10 billion valuation. Like, it was crazy.
Yeah.
That same thing did happen in 1999. But if you take a look at the amount of IPOs going on today, there's actually less happening. So I do think that, yeah, the market may be a little bit expensive today, but I do think that it is also made up of higher quality businesses today. And I'm not really seeing too much of that crazy slide deck 10 billion market cap shenanigans happening today.
Luckily, retail investors are being sheltered by crazy venture capitalists instead. Those companies stay private at those valuations a little bit longer now.
Yeah, agreed.
Yeah. Do you think some of that sort of more irrational, like exuberance is happening in like the VC world, Braden? And do you think there's a bubble there?
Look, I mean, like I said, capital flows like water, and huge funds were raised in 2021. Right. And they are now at a period where if they haven't deployed it, they have to return the money back to their investors. So they're going to go deploy it because they make money when they deploy it. That's, AUM fees, there's carry fees, there's performance fees. If you tell me, if you give me $10 million to invest in VC money or in VC companies like venture-backed ideas, and next week it's the deadline where I got to give you your money back, or I can go deploy it in some startup that I'm hopeful about, what do you think I'm going to do, right? All the incentives are for me to go deploy it. So of course, capital flows where it's best, easiest to deploy. It flows like water.
When I think about that, like, and I think about like the wild amount of like VC capital going to AI, and then you think about, okay, those AI companies those startup companies are potentially the ones fueling the web services. I don't know if either of you know, like I don't off the top of my head, but like the percentage of, how reliant are like the web services businesses from like Amazon, Google, Microsoft on that like sort of AI boom that's happening in the startup market. Because that's where I was sort of on before, where I was saying, are these companies the ones selling the shovels, or are they the ones like capturing like that underlying value? Because if it is such that like, okay, it's being heavily driven by like this VC funding, does that concern you guys at all, or not so much?
No, it's also Fortune 500 money.
Yeah, I struggle to see VC funding being a huge risk. If VC is in a little bit of a bubble, like, I don't know how that would affect me personally.
Yeah, that makes sense. I guess the shifting to another question I had, like, what do you think, if anything, would result in like a .com sort of situation where you see sort of a correction, or do you see risk of that happening? Do you see any factors where it's like you're looking out for in that regard, or not really?
The market right now is very different than 99, for example. I think in your question you had that you prepared and sent us before was like, is this the next pets.com, or is this the amazon.com? And I was really curious about this. So, you know me, I go into the filings of before they went defunct of pets.com, and the filings from 1998 and 99 from Amazon on their website, and on FinChat. Amazon was doing nearly 1.8 billion in revenue at that time, and pets.com had a few 100,000 in revenue.
Wow.
And spending
Yeah.
$1.6 million a quarter or something, or sorry, 160 million per quarter in operating expenses. And so these businesses were completely different, right? But they're a similar story, right? It's the .com story.
Mm-hmm.
I don't think that this is such a AI narrative bubble story, but it's a price to perfection story. And that's where the risk is, right? It's, if you have something absolutely priced to perfection, there's real business. There's real fundamentals here. I mean, I think estimates on Nvidia free cash is like 50 billion in 2026. And that is a real path to that. Like, there is a real path to that. So this business is on fire. But many of these things are priced to perfection. And if you have a super long, a rush to have a compute build out cycle that has any sort of wavering or showing any sort of weakness, there's going to be a drawdown, but maybe that's a good time to accumulate more. So I think it's very different, but it's not a narrative story as much as it's a price to perfection story.
Yeah, that makes a lot of sense, Braden. Like, when I think about the most recent earnings, it's quite funny, right? You had Microsoft, and I had the numbers here. Like, they had their revenue soared to like 66 billion. It was up 16%. Their profits were up to 25 billion, up 11%. Their cloud revenue grew like 33%. And then they dropped like 5%. Their stock dropped 5% on earnings. So it was like, okay, well, why? Well, it was like, well, they forecasted a 31% increase in their cloud business rather than 33%. Right. So, and it's like, well, 31%, that's still incredible, like growth. But to your point, Braden, it's like very much like price for perfection. So yeah, that's very interesting, right? And I appreciate that distinction in terms of like pets.com is like true junk, or even some of the SPACs, right? Daniel, they were talking about in 2021 was like true junk. It's like, these are true, great businesses that are the expectations are just so high. Daniel, anything to add or on that side?
Yeah, that was just a great answer. I would agree. I think a lot of stuff is priced for perfection today. And as a content creator, I make videos on all the earnings coming out and whatnot. And it's just funny the questions that I get when, as you said, Microsoft reports a fantastic earnings report and then the stock is down and everyone's like, well, why is this happening? And it's just, it is priced for perfection. Microsoft, maybe not as much as other stocks in the market today, like Palantir, but yeah, for me, it's a little bit too risky for my appetite when something is so priced for perfection because the future is forever uncertain and I have no idea how things are going to play out. And, if Palantir wavers a little bit, then that stock looks massively overvalued today. Like that company has to continue growing at 30% plus for the next decade just to justify its price today. And if it even slows down in 2028, then the price today looks high. So yeah, I think that is the risk in the market today, is just how priced to perfection everything is.
Yeah, that's interesting because I feel like I hear kind of two sentiments, which I think do make sense at the same time, where it's like both of you guys are like, well, AI, we see all these companies, they're growing massively. There's huge potential here. But at the same time, it is very risky, right? And it's maybe not the same as like a .com like style bubble, but you can see big volatile swings if the companies like miss their marks, even a little bit. How has that affected your guys' investing strategies? I know, Daniel, you mentioned sort of, investors should maybe lower their expectations. You're seeing maybe more opportunities in other areas for your own personal investments. And yeah, I saw a comment, of course, like this is obviously our personal opinions and not financial advice. But Daniel, yeah, what are your thoughts on that, and how has it affected your investment strategies?
Yeah, it's a good question. So as Braden said earlier, the S&P is really just a collection of 500 businesses, and we refer to it as the market. But the reality is there's, I believe, tens of thousands of stocks out there. So I am someone who believes there's always value somewhere. And currently I'm just finding value in other places in smaller cap stocks right now. So I'm not someone who's buying a lot of large cap stocks. I actually don't even hold a lot of large caps today. And I'm just continuing to add to the smaller cap companies that I think are being overlooked by everyone and still offering quite a bit of value, in my opinion. So if the market corrects, or if the S&P corrects, I really just don't care. Like, it's not something that I actually focus on or try to predict. I just try to stay focused on fundamentals and buying good businesses for good prices.
Braden, what about you?
Yeah, I'd echo the same sentiment. I think that there is a lot of opportunity in small caps, mid caps, with the caveat that they have global opportunities. I think that that's one thing that investors have missed, and then, screamed up to the heavens and gone, why is my mid caps underperforming? And they'll be looking at something that has just strictly domestic opportunities. That has been the story of investing in my lifetime. In my view, it's been exactly the example I showed you before of the top 20 companies 20 years ago versus the top 20 companies today. I think that there's great value in markets outside of the US. I think that there's great value in Latin America, Canada, UK, Australia. But the ones that are doing exceptionally well have opportunities beyond their own border that they operate in, beyond the domestic business that they pursue, maybe in their home country. Just because they're a small cap doesn't mean that they don't have opportunities outside, but that's a requirement for me these days. It's just the writing's on the wall, right? We live in a very global economy today.
That makes sense, guys. Yeah. Well, I have more questions here, but would love to start opening up more questions from the audience here. So if folks have questions, feel free to put them in the chat. And then if there are questions, I'll pull from there. If there's not, we can keep up with the discussion as we're going. And let me look here. And hey, Regis, how's it going? Good to see you, and appreciate everyone tuning in. We've had I think we've had a few.
How many people are live right now?
About 100, I think, and people are jumping in and out here.
Nice.
I believe so. It's yeah, it's great to see all you guys here in the chat. Zach Hartley, we start with this one. What is the largest risk to the industry? Zach, I'm assuming you mean just AI industry in general, or what do you mean by the industry? Maybe we'll start.
I think he's
We'll
talking
start with
about AI.
yes,
Yeah,
AI.
probably.
Yeah. Okay.
Yeah, he says yes. Yeah, the largest. Oh, go ahead. Yeah.
Oh, I was just gonna say the largest risk for the industry, and I'll say the industry because most of these companies are not publicly traded. The industry is the new startups, it's the people hacking, and it's the kid that's graduating in 2 months from Stanford who is about to build $1 billion company. This is where the industry is today. It's people like me and Daniel, and of course there's the big infrastructure companies that are publicly traded. But the big risk is that what I'll call horizontal software companies, OpenAI, Microsoft, the Amazon-backed Anthropic. So what I mean by the startups with the big tech money printer pockets, that they just go super vertical with everything. So they're really horizontal right now, but if their technology becomes digital god and can solve every verticalized application, like guys like me are toast. And so that's some of the biggest risks in the industry, is that digital god does get achieved, and the people building really awesome niche verticals, it's going to be harder and harder for them. So that's what I view as the biggest risk.
Yeah, for me, in terms of the public markets, I think the biggest risk would be if these companies do eventually slow down their AI spending, because as we said earlier, I believe everything is kind of priced as if this is going to continue for years to come. And then, in 2 years, if capex starts to slow down, or these companies see like, hey, we don't need any more GPUs, that would kind of be the point where I would see some risk. So yeah, that's something that I would watch out for.
Mm-hmm. Yeah, I think that makes sense. And echoing that, Daniel, yeah, it seems like I could also see if sentiment like just changes, right? Like we're currently like there's a lot of optimism and excitement around like AI, and I think like sentiment can change quickly, right? And currently it's big tech's able to justify that massive spending because they're kind of being rewarded for it, right? Like, do you guys see a risk of that like flipping or that like sentiment flipping as it sort of did in the sort of .com? And actually, maybe on speaking on that, like the .com, Braden, you mentioned like the difference between the junk companies and the good companies, right? And you have companies like Amazon, which did stand the test of time. But even in the .com, like when the sentiment changed, even Amazon dropped like 80%, and it's since like 200x. But like that obviously like 80% drop was like painful. Like, do you guys see like a sentiment shift being like a big risk?
Yeah. Have you met public markets? Have you met Mr. Market? He's a rational bipolar being, right? And so that's exactly what will happen if there is a shift in sentiment. If it's something's priced for perfection, it doesn't take much. I tweeted the other day about Google and Google search and some changes. Oh, thanks for pulling up. Some changes around LLMs and LLMs plus search, right? These types of businesses. Google is a fantastic company today. I mean, it owns some of the premier assets in the world, between G Suite, YouTube, Google Search, even some of their bets with Waymo, and a long list of services that touch billions of customers. However, today about 55% of their revenue is from search. And search is fantastic. It's an amazing product. It's had product market fit for so long, and it just prints money. But it doesn't take much of a sentiment shift from a monopoly like Google that has 90% of browser and search share for it to go to 86 and the narrative to get pretty ugly. This is one of the blessings and curses of investing in publicly traded monopolies, publicly traded monopolies are fantastic instruments to make a lot of money. But when the status quo is complete dominance over the industry, any little wavering is not good, right? Like if I own 90% of the market and it goes to 80, that's not good. If I'm Nike and I do 50 billion in sales for footwear revenue, and On Running and Hoka are now doing at a run rate of around 4 billion combined, that's not good for Nike stock. Nike stock's on a huge drawdown. So the sentiment can change very quickly, to answer your question. And it doesn't take much for something that owns so much of a market to then just go down a little bit for the story and the narrative to shift massively. Because what happens if 86% turns into 72%, into 50%? You don't have this dominant search business anymore. And that's a real risk for Google and the equity, because the equity is built on 90% market share in their core revenue segment. And so I think that people need to kind of be aware of that. And if they haven't tried some of these LLMs with search buckled into it, oh man, it is amazing. Another little key insight from someone who's in the world of with their big tech APIs. Google, for the first time, allowed you to see the graph and the search data that they've held so close to the chest for 30 years in the Gemini API. This proprietary gold mine is now in the Gemini API. If that doesn't signal panic, I don't know what does. Like something that you would have to break in, like you'd have to do Ocean's 11 to break in and get this code. Last Tuesday, they just opened it up to the whole ecosystem. So things are changing rapidly here.
No, 100%. And I mean, even I noticed in my own behavior, right? Like using ChatGPT, like far more consistently for search rather than going to Google. And so I think that's a very interesting insight, Braden, around like, you know, how maybe it's unsurprising, but like technological disruption will disrupt industries, right? And so, yeah. And speaking of disrupting industries, Bradley here had a question around Apple, maybe another company that has sort of, you know, maybe not as big of a monopoly as Google, but certainly in the US, I think like a massive majority of market share. Any thoughts on Buffett selling Apple? And I know
Pronk has hot takes on this one, so I'll defer to him.
Yeah, I have a few thoughts. So my first thought is actually that I don't think Buffett should be a proxy for what the individual investor should be doing. I mean, this guy's working with hundreds of billions of dollars. He simply can't deploy that capital effectively anymore. His circle of investable stocks is, I don't know, maybe 50 at this point. Whereas for us, it's tens of thousands. So I don't look at Buffett selling Apple and holding cash right now as an indicator that I should be doing that. And I think that there's a pretty big difference between him and the average investor nowadays. With that being said, I think Apple is extremely expensive today. This is a business that's not really growing anymore. Sorry, my voice is hurting today. But yeah, this is a business that's growing quite slow today. And it's selling for something like 30 plus times cash flows. I don't know. It looks very expensive to me. So I do understand if he's selling it based on some sort of valuation multiple or something like that.
Buffett made the best investment maybe in history when everyone said he was all washed up in late 2020, when he backed up the whole balance sheet on Apple stock, and a few years earlier in 2016. But the nuance is very important. I just went on FinChat and graphed the PE when Buffett made those transactions, and Apple was trading at 11 times earnings and 16 times earnings respectively during those massive transactions. It peaked at a 40 trailing PE in 2021-ish and is now at 37 on the trailing earnings. It's at 36.88 today. So this context really matters, right? Like Apple is a fantastic business, but Buffett is a value investor from day one. He buys fantastic companies, which is one of the keys of his success. Apple is nothing short of exceptional. But this is a very different conversation from now to when he made, in my mind, dollar for dollar, the best investment of all time in Apple.
Mm.
Yep.
Yeah. Or sorry, Daniel, go ahead.
Yeah, I just completely agree. And Buffett wrote in some of his shareholder letters that he thinks no stock is a hold forever investment, despite some people maybe thinking otherwise. He's always adaptive. He's always adapting to what the prices are doing, what the modes of businesses are doing. So I think that him changing his position on Apple so dramatically is clearly him believing that something has changed. And in my opinion, it's just the price. And also, Buffett writes a lot about how companies should only buy back shares when their stock is cheap. And if a company is not doing that, and if they are buying back shares just to buy back shares at any price, it's actually a red flag. That's kind of what Apple is doing today. In my opinion, it's a very expensive stock, and they're spending all of their cash flow, pretty much every dollar of free cash flow, buying back shares. So based on the historical writings of Buffett and what Apple is doing with cash flows today, it's kind of an indicator that they don't know what to do with their cash, and they're getting very low returns on the money that they're actually making today.
Mm-hmm. Yeah. No, that's interesting, guys. And just I'll use it as a quick opportunity too to shout out both FinChat and Stock Unlock, because I think, Braden, you just pulled those numbers up on your screen like in like 5 seconds, right? Through FinChat, and I'll put it in the comments here. FinChat, Stock Unlock, both like awesome tools for like the quick like research on these fundamentals. I wanted to build on something and maybe just for the audience watching, because I know we have a lot of beginners on Blossom, and you guys are definitely, I would classify from the conversation more like intermediate to advanced, like fundamental investors, right? Where you're looking at like the numbers, you're looking at valuations, you're looking at PE, right? You're picking different stocks. Both of you, I think, have like a huge allocation in a couple companies that you have high conviction on. How do you think about like the long-term investor, like the beginner investor, like all the concerns around bubbles in the markets? Like a question from Mekdim Direj, like should people be modifying their strategies from your perspective, or how should maybe more beginner long-term investors be thinking about all of this discussion?
Yeah, my opinion, if you're a beginner, most likely the best thing for you is just to buy ETFs. And if you do have a long runway ahead of you, I would honestly just ignore everything we're talking about. I think that just dollar cost averaging ETFs and just sticking with it is the best thing that you could do for yourself long term. And yeah, it's pretty much what I would do.
Yeah, I think this ties what you just said and what we were talking about previously really well together, which is, yes, if you're a beginner and have a lot of the things we said today don't make sense, or have like you're not there yet, just buy low cost index funds and let it ride. But with the caveat of understanding what you're buying. You're not buying some magic ticker that goes up over time. It's a collection of businesses that are in an underlying basket that is being tracked for you. And, you know, some asset manager is holding them for you on your behalf, and you have a claim to the ownership. But there is an underlying group of companies that we've been talking about a lot today that will drive the results that you're going to experience over the next little while. So I think that it's great for simplicity to just own that, set it and forget it, but also have an understanding of, one, the market is extremely volatile. If you are investing in the short term, it is not norm. It's not irregular to see large 25% drawdowns on your capital. We saw it in 2022. That wasn't that long ago. The S&P 500 had a 25% drawdown. You lost a quarter of your money in around 11 months from the end of 2021 through to the end of 2022. So buckle up, be prepared for that, stay the course, keep adding. And two, understand that, yes, you are buying this instrument, but underneath it is a set of businesses with business fundamentals, business decisions being made by management team, macroeconomics forces at hand here. And so you can be passive, but it's also nice to pay attention.
Yeah. And Daniel, I think one of the things you called out in your video to add to that topic really is like around the expectations. And Braden, you said, in 2022, right, market dropped 25%. In the last year, market's up like 36% or something. And by market, again, talking about S&P 500. I think, Daniel, you said something around like lowering your expectations, and obviously like the current returns, if you look on the last year, are very atypical compared to the 30-year trend. And so I think, Braden, that's what you mean when you say long term, right? If you look over the last 30 years, you'll have some years that might be plus 30%. You have other years minus 20%. And like, we shouldn't be expecting like 30% every year, right? So anything to add on that?
If you stat out return buckets every 10%, so what I mean by that is like, here's when it was minus 30 to minus 20, minus 20 to minus 10. You have return buckets on a normal distribution curve of by every 10%. By the way, it almost never returns in where its average is, which is around 10%. A market almost never returns 10%. If you look historically, there's only been 2 times in the last like 70 years or something where it's actually been in that little bracket of a few percentage points of the average. So what does that mean? It's normal for negative 25 and normal for huge years like that. That is more normal than what the average is set out to be. So if you buy stocks thinking, I heard that this asset class is around 10% average annual return. It does, but it almost never returns 10%.
Yeah, the 10% goes like this, right?
Yeah, exactly. The market climbs the wall of worry is like what people say.
Yeah.
I was trying to pull it up, but it might take too long. But yeah, that's so interesting because, and I think that's when a lot of people say, timing the market, right? Like it's if you miss one of those years, that's like one of the big years or small, and it's like very difficult to know when those will be, right? If not impossible. And so, Mekdim, thanks for that question. And it sounds like, for beginner investors, especially with the long-term time horizon, and Braden, that was an important point, I think, that you said. Like if you're investing for short-term, as you guys spoke about, there can be big swings even with S&P, and that golden number around 10% average return like is the average, right? And you need long time horizon.
Be very wary of market predictions.
Yeah,
they're always wrong, and 2, it's just not that useful to know what the stock market's going to do in 2025, or it's especially not useful to hear what someone thinks that the market's going to do in 2025. I won't expose them, but there was a large Canadian broker who had me as like their panel for their newsletter. And they asked me the question. It was right at the end of 2022. It was like in the holidays. So the market had just had a terrible year. Like after euphoria, the market, like it was gut punch after gut punch every week in the market to a 25% drawdown. So that's the context of where we were. And they asked me, and they said, what's going to happen in 2023? Everyone's so bearish. Everyone's so negative. It's been such a bad year. And I basically replied with, it will fluctuate. Because that's the only answer that is the correct answer. And I basically said, hey, look, historically, actually, we're set up for pretty better forward returns than we were if you asked me a year ago. And that's exactly what happened. And they didn't publish the article. They said, they basically was just like, we don't want this answer. We want to know that the market's going to do 16.8% next year for our readers. And I go, well, I can't help you then. Like, throw it out. Thanks for wasting my time. So that's the reality of market pundits and predictions, is that 1, they're useless, and 2, they're always wrong. So like, again, that goes back to number 1, like they are completely useless.
Yeah. To build on that, I believe in my book, I gave some examples of how at the peak of 2021, analysts were all upgrading their forecast for what they thought the S&P 500 was going to do in 2022, right at the peak. And then what happened? That 25% drawdown happened. And then if you take a look at the end of 2022, what they were expecting for 2023, they were all lowering price targets. And then what happened? The market freaking ran crazy, right? So I just don't think there's any value in trying to predict what's going to happen over the short term. I don't think anyone can do it accurately. And I mean, think about if you listen to someone at the end of 2022 when they said the market's going to fall another 20% next year. And now it's up 30 something percent. Like
more.
just,
More. Yeah, that's just this year.
Yeah, that's just this year. Like
that's just this year. Yeah.
Yeah, I don't pay any attention to macro forecasts like that at all.
Yeah. So I think the answer then for beginner long-term investors who are just buying ETFs, it's don't try and time the market, right? And I think maybe for what you guys are doing, it's not really timing the market, but it's looking for, companies with good fundamentals that you think, over the long term are, have a strong story and compelling story. Very interesting and appreciate the answers there. I'll turn it to Justin here on the topic of the AI, and I think someone else had a question. Zach had this question too around, if we look on the industry level, which do you think have the best sector tailwinds, and particularly, I guess, which do you think are best positioned to take advantage of AI over the next few years, or even like the next decade?
I can rattle off 4 right now. So off the top of my head, businesses with unique data moats have a particular good way to take advantage of this. We talked about cloud computing, so we can skip over that. But second order to that, to the data center hype, is look at the engineering of a data center. Who are the suppliers? Who's downstream? Who's a tier 2, tier 3 supplier? Who's building the backup power systems for these businesses? Where are those companies? And there's a good chance that they have had tremendous tailwinds over the last 12 to 16 months. And if they haven't, then that they're not actually benefiting, because you should have already seen that in their financials. And I think you'll see that forward if they are truly benefiting from that. But you might not have to pay such an egregious price. So I like looking like second order to these things when it comes to industries. And then for startups now have, I know this is not relevant necessarily to public companies, but startups now have a wedge to position themselves against the incumbents. It's like, okay, I can't build a better, faster, cheaper mousetrap, but I can build a completely different mousetrap that automates 80% of your day.
Right.
And that's a significant difference.
Mm-hmm.
Yeah, I would completely agree with the thinking a layer lower. So for example, I believe at the Blossom panel that we did in Toronto, I was saying that I thought a company like Brookfield would be one of the huge benefiters of AI and all this infrastructure spending that's going on. I believe Mark Zuckerberg said that one of the major constraints for AI right now is actually just literal energy. They don't have enough energy to power these facilities. And now these companies are looking at small nuclear reactors to try and power data centers. Like, it's crazy. So I look for the companies that are supplying AI with power, and Brookfield is one of those.
Mm-hmm. I'm a chemical engineer and did a deep dive on nuclear power on my podcast 2 Mondays ago. So it's one of the titles of the episode. It looks like Bradley is just mentioning that here. Since Braden comes from an energy background, I'd love to hear some conversations between these two surrounding Brookfield and the energy build out. Yeah, I mean, so Brookfield, I'm long Brookfield Corp as well too. So Daniel and I both own some of the equity. The Brookfield Corp has a pretty awesome set of power assets. They're a very large owner of power stations on river systems. The hydroelectric fleet is one of any hydroelectric fleet, not just Brookfield's, but any hydroelectric fleet is amazing, unique data asset, because we're not building any more rivers. There's no new rivers being built, right? So there's only so much potential energy of, You can build the penstock here and the turbine here. There's only so many opportunities you can do that on the Earth. So those are very unique assets. Thinking bigger around small modular reactors, how they're going to partner with different companies around data centers. I am the nuclear bull in terms of what I want to see in the world, but I wouldn't say that's necessarily comes out in how I like to invest, because I've been involved with these projects. It's 10 years before you even put a shovel in the ground. Construction processes are long. I've been a little bit bearish on small modular reactors, because then you end up basically having these huge, long, drawn-out regulatory processes to get your license to operate a nuclear facility, whether it's a micro nuclear reactor or a 2 gigawatt reactor times 4. You got 8 gigawatts on site. You need the same license. So now you've had this long, drawn-out process for a smaller reactor. And so I really hope the regulation changes around this, but I don't get particularly confident in government's ability to act quickly with these things and do the right thing logically. So I love nuclear, but I think we got to cool our jets on small modular reactors, because it is not conducive to the regulatory landscape at all right now. You have this huge, long process for a smaller reactor. That's bad math.
Yeah. It's good to know. Good to consider.
Yeah. Daniel, any other thoughts around Brookfield before we move on to another topic? I know, it's one of your biggest holdings.
No, I think that was well said.
Amazing. I'll turn to FST's question here. On the note of AI, we talked a lot about individual companies. How do you guys think about AI ETFs? And maybe even to build on that question a little bit from my lens, do you think there's value in sort of AI specific ETFs, even, especially given the S&P 500 like so exposed already, right, to Mag 7 and like AI? I know you guys are more individual stock investors, but are you guys familiar with many AI ETFs?
Personally, no. I don't own any ETFs, and I'm not an ETF guy.
I will comment that there is value in thematic ETFs. The example I always use is, I'm never going to be the expert. Well, never say never. I'm not in a position right now to be an expert in why Thermo Fisher is the best picks and shovels play for biotech startups, right, and genomics evolution that's coming out. I know that there are 250 billion in market cap company and the financials are fantastic, but I'm not in a position to really know that Danaher, the conglomerate of these life science businesses, is going to be fantastic. So those life sciences, biotech, picks and shovels businesses are amazing, but I would rather own that through a thematic play. And so if that's what you want to do with ETFs, that's fine. I would just say, don't overpay for something that just looks a lot like the NASDAQ 100, because right, you can get that for a really, really low management expense ratio. So yes and no. I think that they're useful. Thematic ETFs are very useful, but you can probably get something that looks a lot like it for a fraction of the cost.
Yeah, that's a good point. I did own one ETF in my past, and it was an Indian ETF. I'm pretty bullish on the Indian economy, but I don't know the macro over there. I don't know the dynamics. So I kind of just wanted exposure without having to do all the deep research. So I bought an ETF. Then later on, I did end up selling it, but that's kind of when I would buy an ETF. It's a good point. Yeah.
No, that's really interesting. It's like, I think that's a great point, Braden. It's like you can look at the underlying holdings of the ETF. Don't just blindly buy an ETF either. Like look at the research of the ETF, look at the MER or the management expense ratio. And little plug, like you can do that all very easily on Blossom. If you click on the ticker, you can see
click on
it. Everything. Yeah.
An example that me and Simone, my co-host of the podcast, we did a segment on the. So for some background, there are more ETFs today than stocks.
Wow.
Who would have thought, right? Like there are more ETF listings than stocks by a lot now, by like a significant multiple, because they're asset managers, traditional mutual fund managers need a new way to connect with where there's real liquidity happening, which is on stock markets.
Mm-hmm.
So there's a lot of crap that's been out there that's been marketed to fit some sort of need, and a lot of them are just pure marketing. For example, we found an ETF that was called the vegan ETF, and it was, I kid you not, guys, the S&P copied and pasted. I kid you not. It was literally the exact same as the direct weightings of the S&P 500.
Did it
Like
have a higher
Exxon Mobil is vegan? Like what?
Did it have a higher management fee too?
Of course it did. Of course it did. It was like 70 bips for this vegan ETF, and it was just so. Back to my point before, there's kind of junk everywhere. Use your wits about you. Thematic ETFs are fantastic for certain use cases, and it actually is a really good place to do some research as well. So if I look at some AI ETF and I see the second largest holding is a company called ASML, and you're like, holy, like this is a huge company. What's ASML? You dig in, it's like this largest company in Europe beside LVMH. It's like 250 billion in market cap. And you're like, what is this? That's a good place to like realize and flip over some new stones, because you're not going to learn about what ASML is on a conversation walking down the street. It's this magic business that operates out of the Netherlands that rules everything we do when it comes to creating semiconductors, but hardly anyone knows what it is. So it'd actually be a good place to start some new idea research as well.
Yeah. Maybe building on that, like when you guys think about geographic exposure, because I know, Daniel, you were saying you see more opportunity in international markets. Braden, you're obviously mentioning like these companies in the Netherlands, which I feel like, especially Canadian investors, and I know Brandon with a lot of his looking at portfolios on our TikTok, that's one of the things he'll often call out is like overexposure to like Canadian markets. Like, how do you guys think about that? And also weighing like our conversation before around, a lot of these US companies, even if you're invested purely in US, they are global companies at the end of the day, and they have a lot of their revenue coming from international markets. How important do you guys think it is to like get exposure to international companies and not just, I guess, international revenue through US companies?
Yeah, for me, it's not actually something that I consider at all. I just try to find what I think are the best businesses possible. And if they happen to be in Canada, which a lot of them surprisingly were for me within my circle of competence, then I'm happy to invest in the Canadian markets.
Right.
As we were saying earlier, though, like I do think about where the revenue is coming from. Like Alimentation, for example, they're mostly in the United States. Like the vast majority of their revenue is in US dollars. So yes, it trades on the Canadian exchange, but it's actually pretty much a US company. And that applies to a lot of things, like even Constellation Software. They have revenue coming from everywhere. So yeah, I don't think about it too much, and I don't have like an allocation in my portfolio that's like I have to be 40% Canada, 60% US or something like that. It's not something I think about.
Yeah.
I don't care at all where the listing is, but I do care a lot where the business is done. One of the added bonuses that are just kind of come secondary, but one of the bonuses of if you do find one of these gems that trade only on international markets, you just have way less investors looking at it and or are arbitrarily constrained out of it. Think of how many big US pension funds are constrained out of Constellation Software because there's no direct listing on the New York Stock Exchange or the NASDAQ, which is by design from Mark Leonard. And so I don't care where the listing is, but there can be the added benefit of if it is on a listing that is not the NYSE or NASDAQ, you can come with some better multiples.
That makes sense. Yeah. So it's interesting, right? Like it's essentially, as you said, Daniel, right? There's opportunities everywhere. you're researching the company, you're looking at the fundamentals. If it's attractive, it doesn't matter where it's from, right? And I think for those more intermediate advanced investors that want to do a lot of that research, again, shout out FinChat and Stock Unlock. I think you guys have made it easier than ever before in history, right? To analyze and look at the stock and look at the fundamentals and get that data. And looping back, I guess, to the more beginners who are more on buying the ETFs, buying the indexes. It's some of that's going to be less relevant for you, but I think we've gotten through most of the questions here in the chat, and so I feel like we're coming to a pretty natural place here to wrap up the discussion. Braden and Daniel, maybe to wrap us up, and any final thoughts or any reflections on our awesome chat that we had today.
Go ahead, Daniel.
Man, I never know how to answer these questions well. I think we covered a lot of great stuff here. I do selfishly want to ask Braden a question.
Yeah, go for it.
If that's okay.
Let's hear it.
So as a Constellation software holder myself, I'm an investor in the business too. The number one thing that I see is that AI is going to disrupt that business. Do you have a very quick response on, do you think that's actually a risk for Constellation?
Great topic. So there's been a lot of discourse around software companies. If they can be coded up by a computer, does that not ruin the moat of the IP and all the software? The code base being the IP becomes commoditized, right? That's the whole discussion that I've seen go around. People are like, Salesforce is useless. Some guy will program the whole thing in no time. And so there's two issues with that thesis. Is one, distribution still matters. It doesn't matter if you build a better mousetrap. Distribution is everything. And so that's one of the difficulties of, penetrating any industry, but especially software. But that's not enough. The more prescient issue is that anytime as building a software company, there are complexities that no one would even imagine come across your plate. There are complexities that you would have never thought, like Maxwell, with the app, Pronk, with Stock Unlock. There are complexities in the code base and in software and bugs that come up that you didn't imagine years ago you would be trying to solve, right? They're happening constantly. Every day you're fighting these fires. Anytime we run into those complexities, they're edge cases. And our world is edge cases. Everything, the reason we have a valuable asset is because we're covering edge cases. And AI is not going to be able to naturally solve every edge case. It is an amazing tool for developers to use, but it is not just going to naturally build all of these products with all of the things that humans require to be effective anytime soon. Never say never, but there is not a bot I can set tonight that's going to replace swimming pool team management software that Constellation just bought for $4 million. That's.
No, that's a really good point.
Also, they're so niche in CSU's case that who wants to build this shit? No one wants it. No one wants to. This is why they find great deals.
Is that a real example? They bought a swimming software.
Dude, they have everything under the sun.
Yeah, man, they have. I think I saw one deal they did where they bought a software management company that manages kung fu dojos or something. The most weird stuff they'll buy.
When you go book your haircut with the barbershop and it's that platform that the SMB that you're using has the reservation system and the booking system.
Yeah.
That's owned by some private equity company somewhere. They're all bought and Constellation rolls them all up. So yeah, it's there's money to be made with these things. And eventually every vertical market software company becomes a fintech. on a long enough time horizon, every vertical market software becomes a fintech. Because if you're building that barbershop system software, it just starts with booking. But then what if you want to take payment ahead of time? What if you want to take tips? So next thing you know, you have a point of sale system in the barbershop. Next thing, they always become fintechs on a long enough time horizon.
Yeah, and I'm sure that has a lot of synergies as well for CSU, right? To plug in across the board. No, that's interesting. Braden, any questions for Daniel?
I had a question about your YouTube channel. So
Sure.
the YouTube channel, how do you know? Because I don't struggle with this, but you always just kind of, as a content creator, you always just figure it out, like what to make next. But what is your ideation strategy for coming up with some sort of content calendar? Do you swing it? Like, what's the process there?
Get to see how the sausage is made here, right?
Yeah.
Yeah, it's funny. This question has come up a lot recently in just random conversations, but I would say my channel is very reactionary. So I try to just make content on whatever I think is important. And, at the end of the day, I'm really just throwing spaghetti at the wall and hoping a video works. There's videos that just simply don't work. I do also have videos like the one I think that you liked quite a bit, Max, where I go over the JP Morgan's investor presentation on the market. I do that every quarter. So I do have videos that are recurring, that seem to do very well, that people are interested in. But other than that, it's just like, what is everyone talking about in the market this week? And is that relevant? And can I provide value to my audience in a unique way? And I try to make content around that.
So more reactionary. Okay.
Yeah.
Yeah. Like if anyone's interested in like earnings, like I always like Daniel's YouTube channel for earnings season, you must be up like 80 hours a day. That doesn't make sense. You must be working like 80 to 100 hours a week just because it's like Google earnings, Netflix earnings, this earnings. It's like
Pronk has 30 hours a Yeah,
that's exactly right. No, that's my busy season. My fiance knows when it's earnings season, you don't see me much.
Yeah. That's fair. Well, guys, I really enjoyed this discussion. I guess to wrap it up, we started with the topic, basically AI in the markets, bubble or boom. I think we went through a lot of really interesting data around, whether or not it's a bubble. I talked about the S&P's concentration. We talked about, of course, the price earnings index. And I think the main takeaway I heard for more intermediate investors, right, is there's still opportunities out there, right? And if you do the research from some of your guys' points, like you look at Apple, you look at Buffett selling Apple. Well, when he bought it, the price earnings was much lower. It's much higher today. You look at things like the moat, and I know Braden, you expressed your opinions on one like Google and maybe like their moats at threat. But really that process for a more intermediate advanced investor is like looking at the fundamentals, and as the market is shifting, you need to continue to do that research and FinChat and Stock Unlock, great tools to do that. Of course, Blossom as well if you want more of the social side. And then I think for beginner investors, like the really big takeaway was timing the market is like a loser's game, right? The market can swing up 30%, it can go down 25%. And it's a very challenging, if not impossible, game to try and know when's the time to buy, when's the time to sell. If you're looking at pundits, as you guys said in 2021 they were super bullish. At the end of 2022 they were super bearish. And so that DCA approach, I think, as we talked about, is a really strong approach, especially over the long time horizon. So of course, if I had AI to summarize, they'd probably do a better job than I just did there. But thanks for all of the insights, guys. Thanks everyone who's joined, all the questions in the chat, everyone who's going to watch this afterwards here once they're getting home from work. But yeah, looking forward to the next one. So yeah, cheers, guys.
Yeah,
thanks for hosting, Max and Brandon. You guys are crushing it. And the Blossom app is it's blossoming, full of activity these days, man. Like every time I go on there, I'm like, wow, amazing. You guys are doing something pretty cool.
I think we're at like 4,000 or 5,000 posts a month now, or it might be a week now. It's a crazy amount of engagement now in the community. It's amazing.
Nice.
It's a great way to crowdsource information and research. Like every time I log in there, I get more notifications on stocks I hold about what people are talking about. It's friggin' awesome, actually.
Yeah, that notification system around the ones you hold is a really good idea. I like that one.
Yeah. We do. We one of the things we made that was a change to that notification system, which was really good, was like you can turn off and on ones, because if you hold VFV, you just get like a million notifications about VFV. But no, it's great. Well, anyway, thanks everyone in the chat. Ended great discussion. Max, thanks so much. Bearded Avengers, thanks guys. Great show. Yeah, thanks everyone who's tuning in, leaving comments. We had a lot of fun, and Daniel, Braden, hope to see you guys in person soon. We can grab beers or dinner or so. But for now, have a great night, and yeah, happy Tuesday, everyone.
Take care.
Cheers.
Bye.
Bye, everyone.